In our strategy, we use a 5-phase macro framework. We're not predicting headlines. We're tracking signals, liquidity, and sequencing risk. That's how we stay adaptive late cycle. Markets turned green on CPI. Bitcoin bounced. But the real question is whether this is continuation or just relief. We're reviewing a live segment from Crypto's Us, hosted by George. He covers CPI, crypto price action, ETF flows, and macro headlines. Our role is to translate that into our strategy lens. The video highlights CPI coming in softer than expected. Markets took that as positive for risk assets. That's the immediate impulse we're seeing today. In our strategy, CPI feeds into rates and liquidity. It influences policy expectations and financial conditions, but it's one input, not the whole story. Lower inflation pressure can reduce tightening pressure. That can loosen financial conditions, and looser conditions often support risk assets. Markets don't wait for perfect clarity. They move on marginal change. That's why rallies can happen even late cycle. The video focuses on Bitcoin holding support and eyeing higher levels. We treat price levels as structure, not destiny. Structure needs liquidity to sustain it. In our strategy, Bitcoin behaves as liquidity-sensitive risk. It can lead in easing conditions, and it can retrace quickly if funding tightens. The video notes ETF flows turning positive again. That reflects improving short-term sentiment, but flows are reactive, not predictive. ETF flows tell us how institutions feel right now. They can reinforce trends, but they don't define the macro phase on their own. Silver's sharp move is highlighted in the video. We see that as a real asset reflex. Sometimes it leads inflation narratives, sometimes positioning. This setup, risk on CPI reaction, BTC stabilizing, real assets moving, often fits phase 1 or early phase 2 behavior. Momentum can persist even as pressure builds. Confirmation would mean liquidity improving, credit staying contained, and market breadth holding up. Rising funding stress, widening credit spreads, or yields rising for the wrong reasons. Quick reminder, this is educational macro framing, not financial advice. What changes? We respect CPI as a short-term tailwind. We monitor flows and structure more closely. What doesn't change? We don't chase green days. We don't abandon exits. And we don't confuse relief rallies with regime shifts. CPI can move markets. Liquidity decides whether moves last. We don't need to be early. We just can't afford to be late.